Another huge week in the stock market with earnings from very big corporations, as we can see. Today we are drawing your attention to SoFi that did report before the morning, and what we can see after reporting their earnings, it is down over 10%, and year to date this company has been hammered down 29%. We're going to take a look in today's episode. Why is it crashing? Is it undervalued? Should we consider it as a strong buy with lots of upside? We're going to do the usual analysis of these companies, looking at their revenue growth year on year, as well as their bottom line net income. We want to analyze the health of this company, their cash versus their total debt. And as always, we will look at some very important metrics, their free cash flow, their sales growth year on year. And we want to understand, given their earnings, it was very strong. So what was the reason for this crash? And is this a fantastic opportunity? We'll also look towards both insiders as well as institutions to understand what they have been doing, buying or selling. And in today's episode, we also want to look at their investor presentation. We want to see what they are looking and talking about, not just in terms of their results, but also for the full year of FY24 and beyond, so we can understand this, and we'll incorporate this into our valuation model. We'll get to both our intrinsic value as well as our acceptable buy price, given that investor margin of safety, and we'll look towards Wall Street to see what they're forecasting for the next 12 months. On top of that, we're also going to run through 3 different scenarios for the growth of this company, a low, medium and high, so you can also understand where these numbers are coming from. So let's take a quick look at the performance over the shorter period. We can see, yes, down 10%. Yes, year to date, they're down nearly 30%. Over the last year, however, we can see they are up around 25%. Currently, they trade in the mid to lower end of the 52-week range, and we have 1 buy rating from Seeking Alpha Analyst with 2 hold ratings from Wall Street and Quant. We also note the market cap does sit around 8.31 billion. So let's first take a look, digest their earnings, and we can see the headline does read they surpass analyst revenue forecasts as well as strong Q1 performance. So their revenue was and reported 645 million. We can see a very strong 37% increase year over year, as well as beating analyst target by quite some way, so very positive. On the bottom line, 88 million in their net income, and we can see again, this did beat the analyst target of 18.83 million. When we look on an earnings per share basis, we can see basic earnings per share 8 cents, diluted 0.02, and again, we also note it did beat those analyst targets of 0.01. Also, what I quite like to do for companies is look at their margins, and we can see, in fact, their net interest margin did increase to 5.91% from 5.48 year over year, and as always that does help in indicating their profitability in those lending operations. And something that is quite big for this company, it is their member growth, which did increase over 8.1 million, up 44% year on year, and we're going to look at a lot of these when we deep dive into their investor presentation. And one thing that is always great to see with companies is not just their guidance for the full year, but when they increase that, and we can see they have raised their revenue guidance to 2.39 to 2.43 billion, as well as increasing their bottom line guidance too. So overall, it does look very healthy. Let's have a quick look at this company, how it operates, and understand their increases. Well, as always, on a top line, we do like to see growth year on year of around 3 to 7%. And what we can note over the longer term, December 2017, 507 million reported on their top line. December 2023, just over 2 billion. So we see 4 times growth over the last 7 years. And when we take a look at it on a graph format, we do note the increased growth year over year, other than the inconsistency noted in 2017 to 2018. So since 2018, it has been moving in the right direction, increasing as well. And we'll also shortly look at the quarter-on-quarter increases too. In terms of the bottom line, well, one thing to note, they are still reporting a net loss. So December 2017, it was a net income of 50 million. But since then, we can see every single year a net loss. December 2023, negative 300 million. And we can see when we do look at it in a graph format that every single year it hasn't been the greatest. They haven't yet turned a profit. And we can discuss that and look and see whether or not for the full year management see this turning around. In terms of the health of the company, very quickly, we just look at their cash versus total debt. We see their cash and equivalents has increased from 325 million in 2018 to to just over 3 billion from their latest report. We can see their cash has increased pretty much nearly every single year. When we compare that just over 3 billion to their total debt numerically and directionally, what we can see is in fact it has decreased from around 6.6 billion to around 5.4. So that's always a good sign. Cash has increased whilst their total debt has decreased, and we'll talk about their net debt to EBITDA metric specifically in relation to these two balances. And what we like to do is just analyze some of these different metrics. So the three that we do have available, we have the year-on-year revenue growth as we discussed, very strong, 36%, with the sector median at 4.36. Forward looking, they are also anticipating more growth, just under 22%, whilst we can see here the sector median is anticipating a much lower number, and the same goes for their EBITDA growth on a forward looking basis as well. So in terms of growth, it does have a very strong number, but we're going to start to talk about why exactly the market has hammered this stock if their growth is looking very positive. We also now look at another metric, which is a profitability. They get an F. So whilst they had on the growth a very strong, when we look at essentially their profitability, it was very poor. So two things to look at. The first one is the gross profit margin, 82%, significantly better than the sector median. But when we look at their bottom line, something that we always like to see, indicating a strong company, very nice net income margin in relation to the sector median. We actually note the sector median is positive and much higher at 23.44%. And this does essentially justify when we were looking that they are having a net loss year on year over the last 6 years. We can see across some other metrics as well, not looking the greatest. Cash from operations as well, very poor, over negative 7 billion, with essentially others in the same sector a profit or essential a positive amount of 149.94 million. So growth looking good, profitability not looking great at all. When we see how they performed versus some of their competitors in the consumer finance, we have Credit Acceptance Corporation, One Main Holdings, as well as a few others. We can see over the last year, they are in fact up 24.51%. So that is a fairly strong performance. However, when you do compare it to others in the same industry, they have performed a lot better. We can see here, in fact, SLM up 54%, Ali as well up 58.73%. So nonetheless, when you do just look at SoFi, it has performed fairly strongly over the last year. But as always, it does depend at which point you have purchased shares. The other thing to also note is over the next 5 to 10 years, it isn't necessarily an indicator based on this positive performance just over the shorter term. So something to incorporate into your own investment thesis as well. And when we look at that margin of safety, something you can look towards as well. What is quite nice to note when we look at their earnings per share estimated over the next few quarters, it is expected to be positive and increasing as well. And when we take a look at the earnings, we can see it is expected over the next few quarters to increase very positively as well. For the full quarter of 2024, it is expected just over 75% year-on-year growth. And now we can take a look at insider ownership. What we see around 2.6%. We see over 8 million worth of sales by insiders over the last 12 months on 4 separate occasions, whilst we in fact see 2 buys by 1.29 million. So more insider selling than insider buying. We have to go up to Q1 2024 to see the latest insider selling, and we can see in Q4 of 2023 some insider buying, but again a lot more insider selling. When we take a look at who this was and at what point, we see the Chief Technical Officer Jeremy R in fact sell 19th of March over 56,000 worth of shares for just under $390,000. In fact, we do see him sell on a separate occasion at the back end of 2023 as well. And if you want to go to the latest buy, it would have been Anthony M, the CEO, and we can see here on the 21st of November 2023, 146,000. Whether you want to include this in your own investment thesis, bullish or bearish, given the fact that the CEO did buy, but it was quite some time ago, it may be a little bit outdated to include. We never know why insiders sell, personal or financial, but again, the information is there, the transparency is there to include if you would like. When we take a look at institutional ownership, just over 38%, we see around 89 million worth of sales. However, we see a significant amount more by the institutions, not just over the last 12 months, but as we can clearly see in the latest quarter, 60 million of buys versus 4.3 million worth of sales. So institutions are clearly adding SoFi a lot more than they are selling. So that is something interesting. But as always, do your own due diligence. Now, we just want to let you know we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, do click on the pinned comment below. In fact, this article here is a highly requested one with a lot of in the community asking what are the websites and resources we use. Well, in this article, we do run through every single one. Now, before we look at the metrics, let's just take a look at their latest investor presentation that was just released this morning. Now, one of the first things that we do want to point out is new member additions, which, as we saw earlier, is a very key indicator for Wall Street, as they do include it within their own targets. What they want to see is an increasing number of members quarter on quarter, year over year. And what we can see here, Q1 of 2024, they increased on a year on year basis of 44%. And what we can see here is 8,132, an increase from the previous quarter as well. So that does look quite healthy. And again, the market will want to see quarter on quarter the increases of the memberships. But one thing we do want to point out, we can see it has started to slow down quite significantly from the highs that we have seen in 2021 and 2022, where it was in the high double digits and even in the triple digits. So this could be one argument as to why we are seeing the share price dropping. Maybe the market was looking for a much higher number in terms of growth. We then have the quarterly adjusted net revenue quarter on quarter, and another reason why we may see that share price take a hit. We can in fact note that while on a year-on-year there is an increase of 26%, it has reduced from the previous quarter, and as we see, the year-on-year growth is starting to slow down as well. So it could be here that investors are seeing SoFi as a company with the growth not as high as maybe they had initially expected. Quarter one, however, as we can see clearly, is a drop, but still nonetheless a growth on a year-on-year basis. As we can see here, a very similar story. Essentially, their EBITDA is down from the previous quarter. Now, when we take a look at their results, Q1, well, how did they do versus their own guidance? Well, on a net revenue basis, we can see here 581 million, whereas they were guiding between 550 to 560. So very positive. They beat their own guidance. On an EBITDA measure as well, they beat, as we can clearly see, between 110 to 120. And on a margin as well, looking much stronger at 25% versus the 20 to 21. And finally, the net income also looking very healthy. So overall, when you are comparing it to how they were guiding initially, they did beat as well. So very strong performance in their quarter. Now, what we also like to do is look at the FY 2024 guidance, and this will give us a bit more color as what to expect for the full year of 2024. Now, in terms of their revenues, we can see 2023 actual was in fact 2074. What they are guiding now is 2390 to 2430, and we can see they have increased it to their prior guidance that they had released. On top of that, their growth 35%. Now, this is one of the reasons that we can see why the share price is starting to come down. 35% was their growth from 23 to 22. However, what they are anticipating now, 24 growth from the previous year, to come down to 15 to 17%, even though we can see this is an increase from their initial guidance. And when we look at the adjusted EBITDA, they are also guiding upwards again, 590 to 600, when initially they had anticipated 580 to 590, whilst keeping the margins the same at 25%. Now, in terms of a GAAP net income, well, nice to note, over the last 3 years, as we discussed, it was essentially a loss. However, now not only are they anticipating a net income, as we can see here, but also an increase from the previous guidance of 95 to 105, and the same is to be said on an earnings per share basis as well. So very strong and healthy, and we can also take a look at their book value, which is expected to grow not just from the previous years, but also their previous guidance. So if they do hit all of these targets, it does look like it could be very strong, but the one thing that we have been talking about is that slowdown in growth that could essentially be hurting them right now. And as we do take an updated look, we can see the share price has started to come down slightly, $7.09. So when we take a look, what we want to see is increasing free cash flows year on year. What is positive to note, however, is that next year they are expecting positive of 46 cents, although over the last few years, as we can clearly see, bar 2020 or in fact 2018, we do note it has been negative year on year. Sales growth, what we want to see, double-digit growth, very strong. And as we were looking, yes, unfortunately, it does look like not just that it's slowing down, but in the full year of 2024, they are anticipating 15 to 17%, something we can discuss when putting in our margin of safety. Now, sales, just another format to what we initially reviewed. Shares outstanding, we love it when companies do share buybacks, essentially increasing our position in the company and returning excess cash. What we do know, however, it has increased over the last few years and therefore would have diluted your position as a shareholder. ROE, then this will be negative given the fact that they have reported a net loss over the last few years, but they are anticipating 2024 to have a GAAP net income. Free cash flow margin also negative as we just saw above. However, FY24 they are expecting that 46 cents per share. Net debt to EBITDA, then the earnings before interest, tax, depreciation and amortization. Remember, this shows us the strength of the balance sheet, which we did review earlier in the episode. Now, what we do like to see is below 3. What we can see here is 5.27 in the full year of 2023. What this signals is that it would take them 5.27 years to pay off all of their debt net of cash on hand. What is very positive to note, though, it is expected to come down in FY24 to around 3.92. So if we are starting to see this reduce, that is a very positive sign for the company and the strength of their balance sheet. So let's jump into the valuation model, and as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now for SoFi, we only use the discounted cash flow model. We have the free cash flow year on year, the average growth rate as well, and as we can see, forward looking, we have gone for 8%. Now what we have done, a few assumptions here, is that their future free cash flow for the full year in 2024 is what we talked about earlier at 46 cents per share outstanding, and what we are doing now is using a low end of 8%. With the discount rate of 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get now to an intrinsic value of $9.59, giving us a signal of undervaluation. Now, there may be people who will say that 8% is too low and would be looking at around 10%, and if we were to update this for a 10% forward-looking growth rate, it would give an intrinsic value of $11.17, and that would be an implied upside of 57%. Now, there may be people who say let's use 12%, go a little bit higher, and that would then give an intrinsic value of just under $13, and we can see upside implied of 82. Now, today's episode, we're going to pull through 8%, the lower end to the final slide. And as always, you can grab a copy of this model if you want to get to your own intrinsic value, run your own numbers through, whether it's SoFi or other companies in your portfolio or in your watch list. Now, the intrinsic value for today's episode for SoFi is purely the DCF model that we have used on an 8% rate at $9.59. Now, with the current price hovering around the low 7s, a margin of safety, as always, we do use 10%, which we only execute if we believe it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. We then keep going till it's near that current trading price, and what we can see for today's episode, it doesn't sit too far away from a 25% MOS level based on these estimates and judgments. In terms of Wall Street, what's their expectation over the next 12 months? Well, they see upside of 25% and a price target of $8.91. As always, though, do let us know your thoughts in the comments below. As an investor, is this one that actually makes you happy as there is growth in the company and the share price is down so you can add more shares? Or maybe the lack of growth that we can see on the top line reducing from the high double digits all the way down to 15 to 17% expected in the full year is one for caution. Or even if this isn't a company that you are looking to invest in, let us know the reasons why below. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.